Okay, well, welcome back. I guess it's 12 midnight, so let's continue with the third paper of the joint ABFER CEBRA session, which is bank risk taking and monetary policy transmission evidence from China. And the presenter is Zheng Liu from Federal Reserve Bank of San Francisco. So Zheng, I see you have your slides up.
Yes, thank you, Frank. I appreciate the organizers for putting this paper in the program. It's really good program. I wish I can attend them all. And this paper is joint work with Xiaoming Li of SAFE, Yuchao, Peng, and Zhiwei Xu. We are still working on more data exploration with other banks' data, and we haven't got them yet, but now we have only one large bank. So the issue we're going to talk about is the bank risk-taking decisions, how that risk-taking decision respond to changes in regulation, and how that respond to changes in monetary policy. In the literature, the relation between monetary policy and risk-taking is kind of ambiguous. And some people express concerns after the global financial crisis and again after the COVID-19 pandemic. The aggressive monetary policy easing from advanced economies have led to, these discussions about whether this will create, financial stability issues. In a model, it can go either way. It could say the portfolio choice theory says, well, when the monetary policy keeps the interest rate low, banks would search for yield. They would take more risk, hoping to get higher return. The other polar opposite prediction is from a risk shifting story. Basically, it says banks have this agency problem. They have limited liability. If the interest rate is too high, the funding cost is too high, so they want to gamble for resurrection, so they're going to take more risk. The opposite is true when interest rate is low, that alleviate the agency problem and reduce risk-taking. So in reality, both type of channels can work. So it's hard to identify this taking channel. This paper tried to get to that issue about risk-taking. How do you identify risk-taking? How do you identify the response of risk-taking to changes in regulation and changes in monetary policy? To do that, we use a very detailed micro-level data from China. In particular, we have all the loan information from a large Big Five bank in China. I'm not supposed to tell you which bank it is, and I actually don't know. It's confidential. My co-author got that data. The banking is important financing source in China. Most firms borrow from banks, unlike the US. You have a better developed stock market, bond market, but in China, bank loans are still the primary source of firm financing. So this makes changes in bank regulation particularly important for understanding monetary policy transmission. And there's a big change in the bank regulation in 2013. China started to implement Basel III. Notable changes brought by Basel III include changes in the minimum capital adequacy ratio, or CAR, and also a new internal ratings-based approach to assess the capital ratio, the CAR, by risk-weighted assets for corporate loans. Before this Basel III, all corporate loans are not weighted; they're equally weighted. But after that, they are weighted based on the credit ratings and default risk, etc. So we use this regulation change in 2013 to study how monetary policy shocks can affect bank risk taking. We have a model. It's in the paper. I'm not going to have time to go through the details, but I'll highlight the results. So we use that theory to motivate a different diff identification. In particular, we exploit the cross-sectional differences in lending behaviors between banks that have a high risk portfolio in the past versus those with low risk and before and after the new regulation. Essentially, the high-risk bank branches are more sensitive to changes or tightening in the regulation. What we find is that the Basel regulation significantly reduced bank risk-taking on average, and also conditional monetary policy easing. And in response to the tightened regulation, the banks increased share of lending to state-owned enterprises. These firms are perceived as safe borrowers under government guarantees, either explicit or implicit. And I'll show you some evidence that the SOE firms also receive higher credit ratings ex ante, controlling for everything else. And since Basel III introduces internal ratings-based approach, banks have another margin of optimization, which is the risk weights for their loans on their assets. So in order to reduce risk-taking following the regulation change, banks can, they can change the capital. They can also change risk-weighted assets, the numerator and denominator. But we argue that our evidence shows risk weighting is more important. And this risk weighting mechanism suggests that there might be a trade-off facing monetary policy. On one hand, an expansionary monetary policy shock leads to less risk-taking under the new regulation. So it eases concerns about financial stability. On the other hand, because banks increase lending to SOEs to reduce their ex ante or perceived risk, it causes resource misallocation and reducing aggregate TFP because SOEs are less efficient than private firms. So let me just walk you through some highlights of the model. Just consider a simple environment, a static environment with representative bank who has an endowment E, which is net worth or capital. The bank takes deposit D at the risk-free rate R and lends K to finance risky project with a stochastic return R. It follows a uniform distribution with the expected return and the variance given by these expressions, where the sigma is the aggregate risk. It's like how risky the portfolio is. Delta is a bank-specific risk. It's idiosyncratic. It's related to where the bank is located, who the customers the banks face, and so on. So the effective variance of the project return depends on both the idiosyncratic risk, delta, and the aggregate project risk, sigma. So banks have limited liabilities. They can walk out if the earning on loans are a big R times K happen to be below the deposit payment R times D. So big R is stochastic. So this could happen. So when that happens, the bank just walk away, obtain zero. So the bank chooses sigma, the risk of the project. The project is indexed by that risk, and the amount of deposit to maximize this object, the profit. And the bank faces a flow of funds constraint. Loan amount K is financed through either internal net worth E or deposit D. And the bank also faces the CR constraint, which requires that the ratio of capital E to the risk-weighted asset, C times K, should be above some minimum level. And this C is a function of the risk, sigma and a delta. This is a risk weighting function. If rho is higher, then the risk weighting function is more sensitive to the risks. So we prove a few propositions in the paper. I won't have time to show you, but here just a highlight. We show that when the regulation risk weighting sensitivity, that rho parameter increases, banks will reduce risk taking, because for every unit of risk that it takes, additional risk it takes, it will increase the risk weighting more. So, furthermore, increasing the risk sensitivity rho also reduce bank risk taking in response to monetary policy easing. Intuition is when monetary policy easing happens, banks have more leverage. They're going to lend more. And in order to meet the CAR constraint, lending more requiring cutting down the risk. So that's just mechanically true. You have a larger balance sheet, you have to reduce the risk weights by reducing risk taking. And this last result help our identification. Basically, we show that banks with a higher idiosyncratic risk delta will respond more to changes in regulation, parameter rho. This is true both on average and conditional monetary policy shocks. So going to the empirical side, we use data from this one of the big 5 banks in China from the period 2008 to 2017 quarterly. It covers all the information on loans, the amounts, the price, the credit rating, the borrower type. Is it the SOE in particular? Is it SOE or private firm? And we focus on firm loans. So we do not look at the mortgage or sovereign debt. Those other loans are not in our data. And in order to control for borrower characteristics, we merge this loan data with the firm data from the annual survey of industrial firms in China, which is the largest data set covering all above scale manufacturing firms in China. It's annual from 98 to 2013. And it includes all the detailed information on firms, the revenue, employment, capital, balance sheet information, etc. So we end up with 400,000 firm loan pairs. It's a pretty sizable data set. The empirical specification that we consider is related to the theory. I'll explain this. Dependent variable of interest is SOE IJT, which is a dummy. If loan I is extended to an SOE firm by bank branch J in quarter T. Remember, we have just one large bank. It has like hundreds of branches located in different cities, areas in China. So IJT is an index, it's a loan I, branch J, and quarter T. And on the right-hand side, post Y is the post Basel III dummy. It equals 1 if the year is greater than 2013. And the risk H is the risk history, that delta, the idiosyncratic risk we talked about of branch J. We measure this risk history by the average non-performing loan ratio before Basel III was implemented. So if the average NPL is above median, risk H would be 1, otherwise it's 0. And NP is monetary policy shock. It's the exogenous component of monetary policy rule estimated by Chen et al. In their AER paper. And we include a bunch of controls in XI and the fixed effect, including year, quarter, and branch fixed effects. So let me rewrite that equation here just for convenience of referencing. The theory implies that the parameter alpha should be positive. Basically says that the new regulation, which is represented post-dummy, under the new regulation, risk weighting sensitivity rho is higher. So banks should reduce risk taking, and those risky branches should reduce even more. So the risk H interactive with post should have a positive coefficient alpha. And the parameter beta should also be positive. The theory suggests that monetary policy expansion under the new regulation should reduce risk-taking, so they increase SOE lending. Furthermore, high-risk branches would have even a stronger incentive to reduce risk, so beta should be positive. This is the baseline results, and confirming the prior that both alpha and the beta are significantly positive. If you look at the column 1, where we don't control for the bank-wide CAR, it is the first parameter is beta, the second is alpha. Both are statistically significant. And when we control for the level of the effective CAR in the bank, it's bank-wide. It's not branch-specific. It's bank-wide. That's in columns 3 and 4. You can see the effect alpha and the beta. Not alpha, but beta is our parameter of interest. It becomes larger. What it says is 1.2 to 1 suggests that one standard deviation monetary policy shock would increase the probability of SOE lending by about 14%. So here's just confirming our parallel trend assumption. These are the time varying estimate of alpha and beta. Before 2013, they're close to 0, not statistically different from 0. And after 2013, both alpha and beta become significantly positive. And this slide shows the results when we control for borrower characteristics, because the previous result does not really tell us if the the reduction risk taking is driven by the bank decision, lender's decision, or borrower's demand, demand for loan. So here we focus on the subset of firms that borrow from multiple bank branches in multiple locations. So we can control for the borrower characteristic and isolating the lender or the supply decision. So just focus on column 1. What it does is, we look at whether the branch will offer SOE firms a favorable loan rate, condition on the expansionary monetary policy shock and under the new regulation. It does, negative 18.86. It is the relative loan rate that the branch offers to the SOE borrower. It's a high-risk branch offers to SOE borrower when monetary policy expansion occurs under the new regulation. And on average, without the SOE dummy, they actually charge the private firm relatively higher rate under the new regulation, 15.58. So we did a bunch of robustness tests. So I have no time to go through this. You can read the paper, or in case there's a question later, I can go back to this. So finally, I want to conclude this with some discussion about the aggregate misallocation effect, because banks reduce risk taking by increasing lending to SOEs. And SOEs, in the literature, there's lots of evidence showing that SOEs are less efficient than private firms. So monetary policy easing could reduce aggregate productivity through increasing SOE lending. This slide shows the province level evidence that we have, shows this, confirms this result. Basically, we look at column 1. The TFP growth is the province level TFP growth. Under monetary policy expansion and the new regulation time, post Y, TFP growth will go down when monetary policy is easing. And the channel suggested through our bank risk taking in our evidence shows that this goes through this risk-taking channel because banks increase SOE lending, and that makes the aggregated TFP less efficient. So just to wrap up, We have some evidence from loan-level data and firm-level data that Basel III regulations reduce bank risk-taking, both on average and conditional monetary policy expansions. This risk-taking channel also suggests that an expansionary monetary policy shock can reduce efficiency, although it does not face the financial stability concerns, but reduce efficiency because it increased lending to the government-favored firms, SOEs. Well, this implication is broader than it is. I mean, in China, there's something special. It's called SOE, but in any countries with the industrial policy that favors some inefficient firms would have a similar consequence, in particular trade-off between financial stability and aggregate misallocation. All right, I'll stop there.
Okay, thanks for that, Jen. So let's move to the discussant, Catherine Casanova from the Bank for International Settlements.
Okay, thanks. Well, thank you very much for giving me the opportunity to discuss this very nice paper. I very much enjoyed reading it, and it was a very, very good presentation, actually. The usual disclaimer, these are my own views and they should not be associated with the Bank for International Settlements. So the research question that's explored here is what is the effect of Basel III regulation on bank risk-taking in the particular context of China? And the authors have a focus also to look at the response to monetary policy shocks. They take a twofold approach. They start with a theoretical model, which is based on a bank optimization problem subject to a CAR constraint. So basically a capital constraint. Then with respect to the empirical part, they use data from one particular Chinese bank, and then they look at the different branches and their loan issuance, basically, and the pricing thereof, for instance. They apply this empirical setup to the period between 2008 and 2017. They link this data set, which is very nice, to a firm, to some firm characteristics. In particular, they focus on an indicator of whether or not the borrower is a state-owned enterprise. So they use a 0-1 dummy here. It's a gigantic data set. It covers about 400,000 firm branch pairs. So there's a lot that can be explored. It's very rich, actually. Overall, in a nutshell, the finding is that yes, there is an effect of this capital regulation on bank risk-taking. And as I said, there is a particular focus on responses to monetary policy shocks. So my overall impression, as I said, it's a very nice paper, very rich, a very comprehensive theoretical model. And I very much like that it's the questions also explored then using microdata. So there's evidence on one particular country for a relatively general model, which is very nice. No doubt this is highly policy relevant and it can really inform the discussion. I have some comments and they're basically on the empirical part, or let's say on how you explore the question based on theory, which is, let's say, taken as given for now. On the right-hand side, you can see a sketch of a balance sheet, and this is basically how I think about the empirical approach. So you have assets and liabilities, usually at the parent bank level. Then you have loans and deposits. That's something which is typically recorded also at the branch level. However, wholesale debt and equity, so capitalization, that's usually addressed at the aggregate level, or let's say aggregate level. I'm referring to the parent bank level here. So my comment here, my first one is that branches they are not entirely independent. I could imagine that also in China, there are targets which are provided or which are given by the parent bank to individual branches in terms of their risk return target, or let's say they should provide loans to specific companies. Usually, I think you mentioned it, that there are some, let's say, cities, so there could be, there's probably not a lot of overlap. So there's not a market, but the branches have different customers in a geographical sense, for instance. So in the bottom line is the branches are not completely independent. They are not competing with each other. You could also imagine that when you have a look at this from the parent bank level, there could be offsetting effects. Let's say you allow one branch to take the more risky loans or to be more profitable, and another branch for this at the consolidated level then has to balance for this. The second comment is on the assets and liabilities. I think they are a bit disconnected, in particular in the empirical part. Actually, if we think about managing or risk management of a bank, you would think about the connection between assets and liabilities, because the maturity transformation is at the core of the business model. So I think that's something that should be highlighted here. So overall, the general comment is that in some cases I'm a bit skeptical about the identification, because the branches are not independent. And the second one is that regulation and also monetary policy, usually they have an impact at the consolidated level, which is fine, or let's say this is adequately addressed in the theoretical part, but then the transition to the empirical part, sometimes there's this disconnect. As I said, linking theory and empirical evidence. Let me quote some passages here or sentences from the paper, and let me try to illustrate my concerns here. So the first one is that it said that a bank can boost its effective CAR by either raising capitalization level or by reducing loan risk. However, in the empirical part, you only focus on assets. The liability side is taken for granted, so it's not really addressed at the individual branch level. It cannot be addressed at the individual branch level, actually. I think if you look at individual banks but not individual branches, then that's another issue, of course. Then with respect to the risk weighting sensitivity, shouldn't that be the same across all branches? Because regulation, if it applies at the consolidated level, the risk weights they should be determined at the consolidated level, and they shouldn't differ across different branches in the way you show it. And then finally, when it comes to the measures of risk, so branch-specific risk here is measured by non-performing loans. However, I'm not so sure. I mean, this is one particular measure, but it's at the individual branch level, and that's why I understand you want to use it. But it only considers non-performing loans. So let's say the individual maturity mismatch, if it would be there, is not really addressed. And you can also have other risks at the individual branch level which are not taken into account. And then on loan risk, I think basically you are referring to firm risk. Most of the time you're using this SOE dummy, which is targeting an entire borrower and not an individual loan. You could raise questions here about what about rollovers and new loans? Is there a difference or not? That could be taken into account. And then for the individual loans, you could actually imagine that for one particular firm, there are several outstanding loans. Some of them could be collateralized, some not. So there would even be a difference among different loans at this very granular level. In terms of the findings, I took them in the order here that you present them in the paper, just also to illustrate my major points here. The third one, which is on expansion monetary policy, you look at high risk and low risk branches, as I said, high risk and low risk branches, maybe they are not completely independent. So if one branch is riskier than another, there's an offsetting effect at the parent level. So if the parent sets actually these targets, it will be very difficult for regulation to really have to make a point here, so to say, if there could be an offsetting effect. Then on capitalization, yes, as I said before, that capital is usually raised at the equity level or the parent level, and for other risk rates. When you talk about high risk branches, you look at the dummy for lending or not. It's a dummy, it's not a share. So it's more like a probability. It's not a share of loans. What you could do there is, for instance, you could take the outstanding amount of loans to this particular borrower relative to the whole portfolio of the branch. And finally, what I actually very much like is looking at the real effects at the province level. Some other issues, but these are maybe minor, so this is more like a drafting issue. You're focusing on capital, but what about other types of regulations? So it's Basel III, it's one particular part of it, but there are more ingredients, so to say. Entry or exit of firms and branches, why not using this as, let's say, as a particular outcome? Because exposed, if there was an exit of a firm, maybe it was too risky, for instance. You could actually explore this more. That could enrich your paper. Then announcement effects versus implementation effects. I think you're looking at the implementation, but could there potentially be already an effect from the announcement? The multiple relationships, to some extent, I already captured that. If you think about the different branches, probably if you have multiple, if a firm has multiple relationships, these are probably in neighboring areas. Because, as you said, they are typically in different cities, so it's not possible for each borrower to access each branch. So there's no market in that sense. Then I very much like the way you explain the literature and you build up your model, but later you do not really refer to it. So that could actually help the reader a lot, just to also bridge these different parts of the paper. And then language-wise, in the theory part, you're talking about banks, in the empirical part about branches. So just make sure that in the introduction and the conclusion, you're very clear about what you're talking about. And so finally, let me conclude. The authors explore the question of how Basel III regulation affects bank risk-taking in the particular context of China, and looking at the response to monetary policy shocks. Overall, I think it's a very nice paper with a very solid and comprehensive theoretical model, and there's a rich data set to also provide an answer to the research question. With respect to the findings, yes, the authors show that there is an effect on risk-taking. In principle, my comments are, first of all, I'm not sure about whether the branches are really independent and whether they help you to support. They do not provide you a very good identification, maybe. And then assets and liabilities seem to be disconnected. And I think if you talk about risk-taking, you should have a connection to some extent, and you also should take the consolidated level into account. I'll stop here then.
Hi, this is Frank. Let's see. Let's take a few comments. I think Linda may have something to say. Can you hear me, Linda?
Yes, I could hear you.
Okay, all right.
So very nice work. I have basically two questions. One follows up on Catherine's comments about what is a branch, basically, and if if the bank is regulated at a consolidated level, So, really, if you could say something about what are the boundaries of branches, and also if branches have an ability to move funding across them through internal capital markets, that would be helpful. And likewise, if branches are limited in their ability to compete across locations with their other branches. So just what is the constraints on a branch? And then I guess the second question I have really is about the identification of a monetary policy change and its effects. So those, you would have stimulative monetary policy when you have a downturn, presumably. And, is there any reason to think there might be credit that's directed more towards state-owned enterprises during those periods, as opposed to that just being a fully private decision by the branch? So two questions, one on the branch structure, the other is on state-owned enterprises and credit.
Frank, may I?
Yes.
Yeah. I also worry about the lack of independence of the observations across your panel, and the commentators already make those comments, and including the leader just make it. So I want to switch onto something else. The Chinese adopt the Basel III. But my understanding is not exactly the same way as it's done. So I think some institutional details on how they adopted Basel III is important. The second thing is that when it comes to the risk, whether banks are taking a lot of risk and so on and so forth, we know that Chinese state-owned banks are tilted towards the state-owned enterprise. We know that. And we know that in that period, actually, the government imposed a lot of macroprudential policies and this and that, telling banks to to take less risk. And so the results that you produce is not surprising, but it raises a question about whether it's Basel III or is whether many other kinds of government policies that are pushing the direction of taking less risk, and that induce banks to lend more, or in this case, your bank to lend more to SOEs. Then it creates a puzzle for me, because it's well known that they have this shadow banking problem in 2015 and so on and so forth. And later on, so I wonder how this factor in the larger scheme of things. What is the Chinese government? What is the regulators trying to do with his banking system? It's more than just about taking less risk. And what are the regulations that they're also introducing to try to make the banking system more efficient? As I understand it, they developed the LPR and all this, and the MLE, and so 2018 out of your sample, they make further changes, 2019 for further changes. And now, as I understand it from Zhiwei, that the Chinese banking system is now behaving more like the American one. So I wonder if you can feed more information to your readers, and whether you can use your data to show what really is happening. Is it just about, I think it's more than just about reduction of risk, taking less risk and lending more to SOEs.
Zheng, before you respond to the comments, let me I'll just mention one thing, which is consistent with Bernie. What Bernie just said is that just my recollection. Well, first of all, I totally believe that the Basel III was, given your sample, a large bank probably listed. I just remember at that time, Chinese large banks are really almost more Catholic than the Pope in terms of really being worried about Basel III. They're coming by our offices all the time, but what, as Bernie said, shadow banking, any regulatory arbitrage, that was sort of part of the whole narrative, what was going on at that time. And so how would that, I guess that might feed into a bit of your productivity results So that's a question. You don't have to address it because you got a lot of great comments. So why don't you take maybe 5 to 10 minutes to respond to what you can, and then do the rest bilaterally.
Yeah, thank you for the great comments. Thanks, Catherine, in particular, for a very nice discussion. The main challenge we have is our data constraint. So far, we only have loan data from one large bank, and we are in the process, as I said in the beginning, we are in the process of trying to get data from other banks. So that will resolve lots of those issues about independence between branches, competition between branches, stuff like that. So I'll keep you updated when we have those new data and new results. I can't say much more than that, but one thing I do want to clarify is that it is true that the regulation, CAR in particular, is imposed on the consolidated level for the whole bank. The capital in particular is the bank-wide capital. Branches don't have any control over that. But in practice, the branches do have some room for adjusting their risk composition in their portfolio under some target from the headquarter. They're going to say, well, here's your targeted risk-weighted assets, and if you want to increase your leverage, you need to reduce your risk weight. Or vice versa. So they do have some room between the risk weight and the amount of leverage. And our evidence indeed suggests that the level of CAR at the bank level is not the main driver for the risk taking. If anything, a higher level of CAR, more adequately capitalized years would correspond to more risk taking in our baseline. So we have a control for the bank level CAR. Even after we control for that, we still find that the risk weighting channels at work, in particular in the post-Basel years, you see more lending to SOEs. So we'll keep working on the multi-bank data set and see what we get. And to Linda's question about the monetary policy, we are not taking the systematic component of monetary policy rule from the Chen et al.'s AER paper. They estimate the regime switching monetary policy rule exactly as you said. China's M2 growth is responding to growth gap and inflation gap, but it's kind of asymmetric. The growth gap is actual GDP growth from deviation from some government announced target. So the monetary policy shock measure in our regressions is the residual or the exogenous component of that policy rule. So it's already taken into account of the systematic responses to recessions. And they argue it's exogenous, so we're not doing anything new beyond that. And for Bernard's question, I think the broader policies reforms, there are many things are going on after 2013 in China. I listed a bunch of robustness in the slides. I didn't have time to go through them. Examples include interest rate liberalization, starting 2013 and again 2015, the anti-corruption campaign, and then the deleveraging policy, and so on. So we have actually delved into all this and thought about this, and we controlled for these effects in the paper and still find the risk-taking channel is working. So hopefully that addresses part of your concern. Frank's point about shadow banking, I think is a very good one because that speaks to the leakage or ways the banks can find to channel funds to more productive use. Like a shadow banking is off-balance sheet lending. Basically, they're mostly going to the non-SOEs who are willing to pay higher interest because they're more productive. So it kind of is undoing this effect of the regulation, that induce bank to lend more to SOEs. So that's the on-balance sheet lending, but off-balance sheet, they're still willing to channel funds to non-SOEs. So monetary policy expansion actually in a paper with Mark Spiegel and Jingyi Zhang, we published in GME a couple of years ago. We talked exactly about this issue between on-balance sheet lending and off-balance sheet lending, SOE versus private firm. When monetary policy tightens, in that example, we have a reserve requirement increase. Then it's a higher tax on balance sheet lending. So the banks switch to lending to private firms. That actually improves the TFP when monetary policy tightens. It's similar qualitatively to what we find here and the TFP effect, but it's different channel. So I hope that answers some of your concerns.
I wonder if there's any.
Okay, Bernie, go ahead.
I wonder if there's any opportunity to play to look at the changes in the shadow banking. As I understand it, shadow banking, all the shadow banking products have to be discarded or put back onto the book in 2015, and your sample has 2 years after 2015. The question is not about reduction in risk taking or the change in TFP, but the rich information given what you have and all the policy changes. What more can we learn from it?
Yeah. We can use that data certainly for these broader issues to study other policy questions, including shadow banking. And risk taking is just a particular angle we can study, but of course we can broaden scope.
Okay, well, I think also Zheng, you may want to look. I think there's a comment in the chat that you can respond to, but let's go to the next paper if you don't mind, and you can respond and you can multitask as we go to the next paper.